Hello everyone, it's me the Boss Hog. We're back with another video, and all I can say is it's been an absolute roller coaster. My portfolio has been pinging around like no one's business. I imagine that many other people are very similar. Fortunately, the last few days have been great, which is just as well because the couple of weeks before that were pretty terrible. So honestly, the shape of this roller coaster, it feels pretty accurate for the shape of my portfolio over the last few weeks. So without further ado, let's do it. Alright, so we're going to start with the transactions as normal, because we've got 3 weeks to cover. There's been a few things, but not too many. You can see they all fit on a single screen. We're going to start with the deposit. So this is slightly more than I originally expected to deposit in October. That was aided by some poker and blackjack winnings. So that was nice to get sort of a week or two ahead of myself. We will be adding some more in November, but probably not until the next couple of weeks or so when I get paid again. So might be able to do a little bit before then, but it won't be too much. We'll get to what I bought with that in just a moment. There is a very small withdrawal here as well. This is kind of based on a bit of a laugh that my wife and I had as a conversation many months ago now, talking about dividends and what she referred to as cold hard cash. So I've basically decided that whenever I get dividends from Games Workshop, which is what this relates to, I'm just going to withdraw it. It sits outside of my ISA anyway, and it just gives us sort of something hitting the bank that we can do what we want with. So that's the reason for the withdrawal here. So my net position, as we'll see a bit later, in terms of deposits, more like 24.80, something like that. In terms of dividends, actually some decent ones, to be honest with you. So Kanos here, this is a Northern Ireland registered IT company and one of the largest Workday resellers, as in the publicly listed company Workday. However, it's a very profitable, really well-run business, and I really like it. So I put these dividends right back into Kanos. I think right now it's actually a bit of a, I don't quite want to call Kanos a bargain because it's an expensive stock. But I think it trades on an expensive multiple for a reason, and I think considering it's still quite small, it's already kind of a very nimble little business, and it's kind of planning for the long term in some really exciting ways, in my opinion. So, yeah, I'd like to get a bit closer to Kanos in the near future, but right now that's my summary for 30 seconds. Next up is Gamma Communications. I got around to going on their last earnings call, and I'll talk about that a little bit more later. But again, I'm very happy to reinvest the dividends right back into Gamma at these kind of prices, and you'll see shortly that I managed to get sort of another 8 shares at £10 each. So yeah, that feels great to me to be buying Gamma at that sort of level. Similar with Phoenix, actually. Phoenix Group, yeah, this is one of my largest dividend payers. Pays twice a year, and unlike most stocks, most UK stocks, sorry, it pays the same final and interim dividend. So that's always nice. So this is quite nice at 26p each, and I've got 1,000 of them. So that's a nice big fat dividend. Again, straight back into Phoenix. I'm super happy, honestly, to be buying Phoenix at these kind of levels, so that's great. And in Games Workshop, we've already covered. I didn't reinvest in Games Workshop. I think right now it's probably okay to buy Games Workshop. I sold a fair chunk at 114 and 115 just because I thought it was relatively expensive. But right now, I think it's more or less fair value, so I wouldn't begrudge anybody buying at all. Again, it's a super high quality company, and yeah, I don't think it's a bad buy at these sort of levels. I'm just sitting on my 35 shares for now, and I'm comfortably green on them and in no rush to sell because, like I say, it's a very high quality company for me. So in terms of additional capital, then I won't touch on the ones that I reinvested the dividends on, but I did a sort of scattergun approach really with my additional capital. I've already filled up my personal ISA, so this all went into my wife's ISA. And really, I just, spread it pretty broadly. This one here with the Vanex Semiconductor is worth calling out because I sold out of it in my personal ISA just to do a bit of admin, basically. But I have been buying in and actually timed it reasonably well. I will be adding to this position over time, but not sort of rushing into it. It'll be sort of a 200 a month kind of thing. So just to explain my thinking there, basically, that my personal ISA is quite tech heavy, and so this is a little bit of a rebalancing basically from that perspective. And I tied up a very small gain with this ETF in my personal ISA. I would just add as well that when I was originally buying this, it was extremely Nvidia heavy. It was at one stage like 15% Nvidia. Since then, although Nvidia is still sort of 9.5%, they've got quite a few positions that are sort of in the 10% range now. So sort of TSM, Broadcom, and ASML also join Nvidia up there as well, which I much prefer. I think it's a much more balanced fund now than it used to be. So that makes me excited and more excited than I was because, again, I can't quite work out Nvidia's trajectory at the moment. And honestly, I don't think anyone can. Next up, we've got some infrastructure. Again, this is just one of those things I realised I was missing about a year ago. I think it's quite difficult to get excited about infrastructure, to be honest with you, as an investment, but it is what it is. I think it is long-term an important contributor and important to diversify. I sort of realised as well, a couple of years ago when wars broke out and things like that, I didn't always have the best diversification. It's kind of a long-term aim for me. I still don't have sort of defence stocks or oil stocks or anything like that. So I'm sort of trying to get those positions by proxy. And actually, one of the ways I've been doing that is through my MSI Canada ETF. I would describe this as being very heavy in two specific areas: financials and minerals, basically gas more than oil, but still quite heavy on the petrochemicals there. So I consider this stock sort of quite flat, and I'm sort of hoping to buy whenever it sort of dips below my price. So I was quite happy actually with these price points. I've been kind of swing trading this a few times, sort of on very small volumes, but somewhat successfully. But again, I still like the fundamentals of Canada, so happy to buy there. Similar, really, with my X-Trackers Health here. I would describe this as my mature healthcare ETF. Again, this is a diversification requirement. Plus, I don't really understand the industry particularly well. Have kind of done okay with it. I sort of exited BMY at a reasonable time, and haven't had any sort of major losses in the sector. But I feel like that's more luck than skill, to be honest. So I'm happy again to buy this ETF for that purpose. Then we've got our small cap here. I decided to add to this. I have been selling down. At one stage, it was a fairly chunky. I think I had 100 shares at largest. Currently, I've got 60 from memory. I'm down about 4% in this, and that's because, probably surprisingly to anyone who's not looked at this ETF, it's really industrial heavy. It's about 25% industrials, and that's just a sector that hasn't been doing very well. So it is quite beaten up, and I'm quite kind of happy again to be rebuying this. So sort of, the 40 shares I sold out at sort of 77 and 76. So again, I'm not exactly like, making tons of money off this stuff, but that was a profitable sell. And now we're just buying back in again when I'm a few percent down. So I will, again, I really like the small caps and the medium caps. That sort of excites me. And I think that's part of the reason why I had a very good recovery over the last few days in November, just because those kind of mid stocks have been doing quite well. I'm still more bullish than many on real estate. It has had a pretty strong recovery, I think, for fairly known reasons. But just to be clear, it's because there's a lot of debt in real estate companies, and the assumption is that most central banks have neared or have already reached the maximum they're going to be going to in terms of the base rate, which should therefore mean that this is the most exposed this industry is, and maybe now it looks a bit overly beaten up. Basically, that I kind of feel that, to be honest with you, with quite a few of my positions. I mean, you've got MPW as well, which is its own situation, although linked to that as well as things like DLR. But this, for me, is my main REIT position. And again, I continue to be quite happy to buy in at these kind of levels. So that's what I'm doing. I would describe automation and robotics as similar to sort of healthcare, where I haven't had any major disasters in the area, but that's also because I haven't really got too involved in it. Again, I don't really understand it. I think there's going to be lots of sort of winners and even more losers in this, and I don't know who it's going to be. So, but I'm pretty confident that automation and robotics is only going to become more important in the future, and therefore we're just going to average into this fairly slowly over time. But I did decide to put in a little bit more into this one just because it looked on the cheaper side, just trading slightly under its NAV. Emerging markets, kind of similar to the infrastructure. When I reviewed my portfolio about a year ago, I think it was, I realized that I had gaps in both. I didn't really have much in the emerging markets. So I thought I would get a fund in it. That's really as extensive as it's gotten. Again, I'm happy buying at this level. I did do a little bit of research into the fund and basically saw that it was about 10% under its NAV. I'm also, again, maybe I'm more of an optimist, but I sort of am willing to bet on this kind of stuff in the long term. I think there are some exciting growth areas, and this is, how I'm going to get exposure to it. Then we've got my Dutch fund here. This one's kind of similar to the Netherlands, where it's sort of a play on a kind of macroeconomic and country scale. I think there's a lot to like about this fund. It's super narrow. It's only got 25 companies in, so it does mean that it has been a little bit beaten up recently when some of its bigger constituents have been beaten down. However, last week it was kind of opposite, with Shell actually having a pretty strong performance. and one or two of the other big holdings in there as well, also doing well. So that's good. By the way, I have no idea why my broker sometimes chooses to split out these buys. I think is where it's just trying to match off the buys and sells, and that's how it works. I don't really overthink it. And then apparently I came back for another little nibble here at Canada. I think here my original plan was actually going to put this into Allianz Technology Trust, which is sort of my big tech ETF. But having looked at it, I realised that it's now top heavy again with Nvidia, and that was a bit of a surprise to me because originally it was like heaviest with like Microsoft and Apple and Meta, which are still in the top 10 by the way. It's still sort of fairly on that, but it sort of discouraged me a little bit for the same reasons that the semiconductor had discouraged me before. So I'm sort of thinking what I'm going to be doing with Allianz Technology Trust. I've still got a really great buy. I'm still very comfortably double-digit green. But for now, I didn't really feel like buying. Again, I've got a very large position in that as well, as you'll see later. And therefore, I was just happy to put more money into Canada, enjoy the dividends when it comes in, and sort of build up a stake that I can choose to move around at a later date when I want. So longer than I'd normally spend on these transactions, but I thought it was worth walking through those. Any questions as ever, let me know. And now we're going to have a look at the performance in general. Alright, so first of all, this is my normal table that you're probably used to seeing, but where I'm sort of starting to fill in some gaps in my reporting, and as we get near to a full year worth of data, I've basically gone over here and filled in any weekly gaps that I had. The easiest example here is between the 13th and this week I didn't do any videos, or indeed didn't save the end of the week. So I've just sort of copied and pasted what the result was in those weeks. It's not the best solution ever, but it will mean when we start to compare sort of year on year, especially it'll give us a much better idea. But the same is also true for month on month and quarter minus 14 weeks. So now we'll actually be doing true 14 weeks instead of sort of 14 rows up, which is what I was doing before. And because of some gaps, it could skew it a little bit. That accepted, however, actually my portfolio balance here is nearing all-time highs. It may well be an all-time high for how the week has finished. It looks that way. But I have had better into weeks, so I'd love to get to 150. I've never been in 150 before. We're pretty close to there. This was aided by the deposit that we just spoke about, as well as a general performance here in my overall P&L, definitely significant contributor. So sort of a combination here of the big increase that's like 2,500, roughly split by sort of the performance itself, plus the additional deposit. I have to say, if you were to look at my portfolio the previous week to this one, it would have been entirely different. I was extremely beaten up and everything was very red. So it's nice to finish that way. I will just scroll up very slightly here, seeing as it's basically the end of the month, and just to say that it's one of my best dividend months on record here. September and October is quite interesting because Phoenix specifically last year paid in September, and then this year they paid in October. So I was also expecting them to pay in September this time, but it's sort of last year it was the end of September, this year it was October. There were reasons for that, which I might as well explain now, but there's been a change in reporting standards for insurers in the UK. This has created some really significant reactions in share prices, shall we say. Without meaning to go too technical, it's basically something called the International Financial Reporting Standards, so IFRSs, and insurance specifically has gone from 4 to 17, and this has had quite significant impacts on how sort of insurance companies are recognizing both equity as well as profit. So all of the insurers have kind of been doing their best to sort of explain some of these complications. I would say, unless you're an accountant, which I'm not, it is pretty tricky. One of the nice things with Phoenix, though, was that they did spend about half an hour on their recent earnings call and then subsequently saved that 30 minutes sort of Q&A and overview. So for anyone who's interested, you can go and check out that kind of quite nuanced. I also really rate the CFO of Phoenix. I think he does a great job of explaining quite complex things to people who aren't necessarily, actuaries and accountants, and not just any accountants. This is like highly specific. I was talking to a colleague who has who is an accountant, and he was like, "No, I'm not touching that. It's just an unwieldy beast, basically." So yeah, so that's good fun. But that's an aside, basically. That's the reason for that dividend. And because of the fact that now that fell into Q4 rather than Q3, actually, it's been a really good Q4 for me, obviously, with 2 months still remaining and several kind of still quite chunky dividends to come. So that's great. If we then go to the top, I've now updated this, so this is fully accurate. So our target for the financial year, which in the UK is until, I think it's April the 5th, is to get 40,000 into my ISA and my wife's ISA. That will basically be maxing them out, which is the target. And so far at 25.5 and on target basically to hit that. So that will be great. Pretty close reconciliation this week between my document and my broker. So that's to be expected, but it's always nice to see. The only thing really to call out here that I haven't already touched on is just to confirm the net deposit here, which again, because I withdrew £17.50, gives us this figure rather than the 2,500. So don't have too much else to add beyond that. This graph here, though, again, pretty wild for me. I mean, this here where my cursor is right now, this is the start of the year. So when I was thinking of the title for this video, this graph was just absolutely wild. And these are like often 2 months. I've been having like 2-month swings, which can be really great when it's going up and really brutal when it's going down. And again, because a lot of my portfolio is in sort of growth, I don't have a ton of the more defensive stocks as a percentage. It does mean I'm pretty exposed to some of the swings, so I do tend to have even bigger swings than the S&P 500. So that's it is what it is basically. I do sort of sometimes feel a little bit gross, but then likewise feel really good when it's going there. So I try and like look over the long term, and this is where data can actually be really useful. So we're back ahead now of the FTSE 350. But actually modestly behind, or moderately behind, I would say, the S&P 500. So some work to do there, and continue to outperform the all-world weighting. So I'm hoping that we get a good finish at the end of December, because that will be my 3-year target that I originally gave myself to review my performance. So we'll see how it finishes. But broadly speaking, I remain fairly happy with this performance. It's not really a true guide of my own performance either, because for the last year and a bit I've basically been restricted on what I could buy and sell, right, because of my my wife's employer, and there's a video about 9 months ago where I explained those details, but it's still good, and I still think it's worth reviewing after that 3-year period. Beyond that, it continues to be pretty wild on this graph as well. So, I mean, look at the last couple of days. I have had some of the best days I've had. I think Thursday especially was like my 4th best day ever. So that's been pretty interesting and wild. And you can see here I was comfortably in the red about a week ago. So that's been a bit of a role reversal as well. In terms of this, I have updated all of this now. You can see the week-on-week changes here are pretty fab. I think there's only like one, which is a very small position here in Elixir. Just while I've scrolled down to this table, I thought about changing this, but I'd already like saved all of my numbers and didn't want to have to do the admin again. But where I've basically closed this position in my ISA and then moved it to my wife's, basically in the detail that supports these tables, I sort of zero it out. So I sort of remove the equation and sort of finalize it. And then where I've moved it then to my wife's ISA, I haven't set it up properly. So I was like, so actually my position at the moment is probably underreported by about £220, and that will just catch up on Monday, basically, but I didn't want to put that in. So I've got like 9 shares in this at the moment, but my deposited amount that I bought that we touched on. So yeah, I didn't want to change it after I'd done it, and just to call that out and explain why that's red. Outside of that, I have gone on a few earnings calls. Just an observation for anyone who's got US and UK positions and they go on earnings calls. Like, UK earnings calls have, I've noticed, started to become more professional, but they're quite different. So first of all, they're often visual, so you actually get, somebody standing up giving a presentation, etc., rather than just, dialing in over a phone like most of the Americans. They're also a lot more relaxed. Like, they make jokes, they're generally more jovial, they sort of have a bit of banter, a little bit of misdirection, and like anecdotes and stuff like that. It's a lot more casual compared to the US earnings calls, which can be extremely dry. So I'll start with Gamma in terms of where we are with them. So I would describe Gamma as pretty solid results. When the results were first announced, they actually went down because EPS only went up 5%, which for like a growth company like Gamma is a bit uninspiring. However, in the notes, and I think like the market did eventually realize, it's 11% on an adjusted EPS, because with the difference being the tax change in the UK, so business rate taxes in the UK have gone from 19% to 25%. I think this will also be a quite common theme, and it kind of bugs me a little bit when the UK government at the moment is looking for ways to invigorate the stock market. And a very clear way of not doing that is to basically tax these companies more, which then reduces their earnings, which then reduces the amount that any multiple will basically come to, right, by reducing the initial number. So that's been an interesting sort of bugbear for me, and a video I've been meaning to make for several weeks to sort of explain how that looks, etc. So Gamma's own range for the full year is sort of 70 to 78p EPS. I personally have penciled in 77, but that's where I think it is, which will give you a P ratio of 14. However, Gamma's got a pretty big cash pile at the moment, equivalent to about 13% of their business. So when you, sorry, of their market cap, so over 120 million, something like that. So when you factor that off as well, it's more like a P of 12. I think that's worth highlighting, which again, I think for a business of Gamma's sort of quality and strategic position, despite being in a very competitive sector, is really cheap. Just my personal opinion, of course. When Gamma spoke about this war chest, I think it does make a lot of sense. Like, they've just brought a cybersecurity company, which I think is an excellent addition, honestly, to the sort of hosting and the sort of IT and telecom marriage, which has kind of been happening for several years. So I think this is an excellent buy. It's not a particularly big one. It's sort of a 50-man organization from Luton, so just outside of London proper. But I think it's an excellent addition, and apparently they're already working on a number of opportunities to sort of cross-sell that into their existing base. So that's very exciting. But Gamma more generally are looking forward to like the analog line switch off, which is happening across basically all of Europe over the next decade or so. The one in the UK, which is their biggest market by quite a margin, is happening in 2025, and there's something like 3 million copper lines that will need to be replaced. Basically, it's no longer going to be viable, and Gamma are sort of keeping an eye out for two reasons. First of all, because they think several businesses won't be able to make that transition, and they might be able to buy them on the cheap. And secondly, it's an opportunity to sort of go in and kind of win some of that business from OpenReach/BT, who've traditionally sort of dominated that market. Now, to be honest, I've been a little bit, I guess, prudent and underwhelmed by this, because I understand the rationale. I think there is business opportunities here, but these are like PSTN lines, which historically would be like £12 at rental, going to digital lines, which historically would be sort of like 5, something like that. And I mean, Gamma themselves are sort of targeting like a notional list price of £4 a connection, so they're not particularly big. However, I have personally, because I work in this industry, right, seen some of the handovers that are already happening for things like cash points, so ATMs, CCTVs, lifts, fax machines, franking machines, right? All of these things run on lines which are no longer going to work after 2025. And actually, the ARPU that's being achieved is significantly higher than £4. I won't say specifics because they're my current employer, and I think I'd get in trouble, frankly. But it's not the £4 that sort of Gamma have worked into their numbers, so that will be interesting to see sort of what the overall revenue per user kind of looks like as an average. But yeah, overall, I really liked the direction of travel from Gamma. I've been bullish on this company for ages. At most of the time, they've been my largest holding. I'm pretty red on them still, down about 25%. But again, I remain very confident in the long term of this business. In line with their dividend policy, that also went up 14% as well. So they have a progressive dividend policy of raising it 11 to 15% a year into the future. So that's also nice to see. And they're sort of on their way to becoming carbon neutral and all the rest of it as well, if you're into those kind of things from an ESG perspective as well. So overall, I really liked the earnings update. I couldn't believe that the share price went all the way down to £10. It's been in the sort of £10 to £12 band for quite some time now, having fallen from like 27. I haven't rerun the numbers following the latest update, but the last time I did, I had sort of a 1950 or 1920, sorry, share price target, and I'm therefore fairly relaxed about that. There wasn't any major changes in this other than the acquisition of the cybersecurity company, and for me, that was a benefit of anything else. So next up, we've got Amcor. So I've also been on this earnings call as well, and now, I consider myself quite close to Amcor, and it was really interesting because I was watching the out of hours when the results were due to be published, and it basically crashed. The out of hours went to like under $19, and I was like, man, that must have been a dreadful earnings update. What happened? So then I went on the earnings update. It was absolutely fine. Like, no factories were on fire. Modest beats basically across the board, very modest beats, like 1 or 2% on quite wide ranges, but decent numbers, margins slightly better, EPS slightly better, everything else. So I was like, what is going on? Anyway, when the market did open, there was a bit of sanity that was restored, and everything else. So I was pretty happy with the overall presentation. I wouldn't say that this is a bargain at this level. Like if it was under 20, I would be again like buying this fairly aggressively. Right now, you're looking at sort of a rolling year of a P of about 14 at 1.4, so not massively expensive compared to other peers in the industry. However, when I was buying this at one stage, it was like a P of 8, and it was just unbelievably cheap. So that was when it was sort of like 17, and again, the market was sort of a bit nicer than it was today. The overall impression given by Amcor, I would say, is that they still expect several more quarters of difficulty in trading, sort of stock to unwind, etc. But they are starting to see sort of polarization across their business and even within specific sectors. So they called out computing, for example, where they had like their best quarter by revenue for computing, which is the largest of four sectors, about 40%. And they were sort of saying, that when it comes to the more advanced stuff, and when it comes to things like data centers, hosting, more advanced computing, the 4 and 5G transition, that kind of stuff. Actually, that kind of industry and that part of that industry is absolutely motoring, like no problem at all. But when you get to sort of personal computing, when you get to sort of the legacy and the general communications, it's pretty rough out there, basically. Still some stock to unwind, hasn't really picked up. Like consumers are spending on services and experiences rather than products. So a significant change. So I think actually about $24 right now, this feels about right. Like I've been saying for a little while that I feel like many of the semiconductors were getting a little bit ahead of themselves. That was part of my reason for selling out of Micron. I would say also when Amcor was at like 28, 29, and I think I sold 70 shares. I kind of wish I'd sold more because it was overvalued by any measure. And I think if I was able to buy back into positions, I would have sold a lot more, like several hundred, which is one of those kind of things that's a tad annoying that I don't have that option anymore. But still, I'm comfortable with this as a long-term hold. It's also interesting because this was one of my bets for the year that it would outperform the wider semi-market. So we'll have to have a look at that closer to the time. But yeah, it was a pretty good earnings update. I always actually enjoy Amcor's presentation. I think it is on the drier side, but I think between the Megan, who's the CFO, and Heel, who's the CEO, who, like I mentioned before, he reminds me of like Dracula impression. But they're both really good. I think they sort of counter each other very well. And again, it's a very easy to navigate deck for what can be quite a complex part of a business. So that was again a pretty solid and reassuring update as far as I was concerned. Q4 should be slightly less, and therefore, again, we shouldn't get too excited compared to Q3, but a slight recovery year on year. And again, I think this is going to sort of be incremental for at least the medium term, the next year or so. I don't expect Amcor to go anywhere too far, unless, it gets hyped with the AI stuff, or, again, their founding family sort of does another secondary listing as they did before. I'm looking forward to Genius next week. They've got some results. They did rise a little bit. The errors here is not unhelped. That's just a Google search, but they did rise a little bit, having fallen quite a lot this week. They basically fell after their last earnings, having run up quite far on sort of analyst upgrades and stuff. I did personally think it had run up a bit too much. I said in these videos before. However, now I think it's actually fallen quite far. My sort of fair price at the moment for Genius would be like 650. So again, I personally think it's quite undervalued at the moment. However, it's definitely not without risk. This still isn't a profitable business and isn't expected to be for another year. It rose in sympathy with DraftKings. It regularly does. It tracks DraftKings earnings quite closely, and basically whatever DraftKings does, Genius just does it because it publishes a week later. I am looking forward to Genius's results. They are out next week, and I will definitely go on the earnings call as we sort of build toward profitability and see how they're doing in that world. Next up, I wanted to talk about Phoenix, really the last earnings call I went on. So yeah, again, I mean, another complex business in a way, which is going through significant change and has had a pretty horrid 2023. So overall, again, I quite liked the overall presentation. There's so much going on with the financial change that I mentioned with the IFRSs. That I want to kind of focus on the most important thing, in my opinion, about Phoenix's presentation, which, to use their wording, is that they have proven the wedge. So far in H1, they basically have more inflows from their new wealth business than they have outflows from their legacy life assurance business. So these are like closed books that they buy historically, and then they basically run down. So it is normal. That's their normal business, basically. Not particularly big margins, and Phoenix are only profitable in that space because they do it at scale and extremely well. So they do still buy closed books and everything else, but it's not the long-term excitement of this company. For me, I think where they're really strong is been their pivot to the wealth management, and they're transformative by really a Standard Life. I think that is they are correct to build on that brand. It's well known in the UK. I think there are some other things as well that they mentioned. For example, they've now achieved break even or payback, to use the proper term, on the Swiss Re purchase that they had 3 years ago. So, and then they expect the overall return on that to be about 120%. So really solid, sort of a 7-year project to realise that. So we're 3 years into that 7 years, and we've already got a break even on the initial investment. So that's great. They're also off to a good start with their Canada Sun Alliance purchase from last year. So they've made 20% payback in 6 months. So similar kind of payback period expected. Something like an 80% overall return on that investment. So again, pretty solid overall as well. So that's definitely exciting. They also have launched their very first annuity product, which I was kind of surprised that they didn't have an annuity product before. But there you go. They basically launched their first annuity product. And they've also got Phoenix Re as a new business unit as well, which is quite exciting. So in the early stages, it's going to basically be them looking to optimize their capital allocation internally. So basically reinsurance internally. But in the medium to long term, they're sort of considering, but I got the impression it was quite strongly considering, having this to basically take on reinsurance more generally as well. So definitely sort of a broadening of what they were doing. So that's, to me, is quite exciting as well. Outside of that, the sort of cash flow, which is the really important part of this business, it's not about assets under management because of the situation with the assets outflow. Was really solid and still on track. It's at like 900 million and the year target is 1.4. They did stress that you can't just times it by 2 and annualize it. Like the way that their business works means that their H2 will not be so good. But that is expected. So they still expect to hit the 1.4 basically this year. So that was comforting from that perspective. And importantly for them, and this was something that Andy, their CEO, was kind of at pains to stress, like actually it wasn't really the cash flow or the kind of business wins that was the exciting part for him. It's the fact that the assets under management actually rose. And he said, like, looking across his peers, like he doesn't really see another company sort of with assets under management rising. That has been aided by some wins, but actually a lot of their bigger recent wins haven't yet reached them and aren't reported in these numbers. So they have 2 billion already won that's going to be in their numbers next year, and then another billion in 2025 as sort of large scale business insurance companies basically migrate across. So these is when you as an individual in the UK have a private pension with your employer. They then win the employer and they move all of their assets across. So those aren't reflected in the numbers. So another 3 billion assets under management to come across, and the money that will go with them as well. So that should be really promising, I think, in the sort of medium term as well. Again, I do think we'll have to have another year or two before a lot of the insurance in the UK kind of recovers from the accounting changes. I still think most people, myself included, honestly, haven't quite got their heads around this just yet. I think Phoenix have done the best job out of the insurers' earnings calls I've been on to try and explain it. So I've been on Aviva, who actually did pretty well, but that's because they're sort of continuing with their turnaround and their sort of simplification of the business. And Legal in General, who had some pretty nasty things relating to sort of house builds and sort of entering into a part of the industry they probably shouldn't have gotten involved in the first place. So a lot of the comparables are really difficult at the moment, and therefore sort of the market tends to be quite risk adverse in them. I do think in the long term this will be absolutely fine, and likewise if I had money available and was still buying individual stocks or could buy them, I would definitely consider Phoenix. It's got like a 1.8 dividend coverage. They've committed to this really lovely future dividend growth, and at the moment it's yielding something obscene like 12%, which normally that's a red flag, but I don't really see it like a red flag like I have or could consider for previous ones. This is one of the most hedged, most defensive businesses I've ever seen. And again, I think a lot of credit should go to the CFO, whose name escapes me now, but he's really credible and does a good job of explaining that. In terms of other updates, I will just touch on Hollywood Bowl. They did a trading update in late September, early October. They will have full year results in December, but sort of no surprises. Revenue on a like-for-like basis up 11%. Canada are already flying. Actually, they seem to be doing a great job in Canada, and they bought a standalone business for about 5 million in Lincoln, a big bowling alley there for 5 million. It was interesting. It took me ages to find the number, and I think it was actually in the press release. I just overlooked it, and I was sort of like, how much would this be? What would make sense? And I was like, mid seven figures is about the right thing, and it was like 4.4. I was like, okay, so at least I felt quite vindicated, understanding the sort of the numbers and how much in a bowling lane is basically a bowling alley is worth on this size. So that made me feel quite good. Some of its peers have released more detailed results that have been positive, and I would say over summer, which isn't normally a good period for bowling alleys because a lot more people would rather be out than in a bowling alley. But for whatever reason, earnings have been sort of not terrible over summer, which, like I say, normally isn't a good period for bowling alleys. And again, so there is a hope that there will be this. My only disappointment with this is that they've guided for a final dividend of 7p, which is underwhelming. It doesn't really align with sort of their long-term plan of having 50% of their earnings into dividends. Like, that's not enough to kind of make the numbers work. And I'm sort of hoping and wondering if, similar to what they did last year, there'll be an interim, a final, and a special. And then, they'll basically make whatever the gap is between the numbers, the special, which would be about 5p, according to my numbers. So I'm going to wait and see what the December numbers look like and whether there'll be anything extra. I don't know. I think at this price point, and I'm not going to change my own opinion just yet, £3.20 is my target here. I would have been buying this a lot more previously. I still think it's okay at this price point. I just think it's, again, depending on also what happens with the dividend, it's not quite the bargain that it was sort of a month or two ago before the peers put out good earnings, shall we say. Outside of that, I haven't had a ton of time to go on earnings. I did see sort of updates from the likes of Amazon, which I thought were excellent. Google is maybe worth just discussing briefly. So I did go on that earnings as well and read the summary. I didn't read the whole thing because it's a big old deck. And I thought Google got beaten up completely unfairly. I actually had a different opinion about Google, which is like, yeah, okay, the cloud revenue was only growing by, I think it was 22%. So maybe that's not what you would like. And it sort of, got smashed a little bit by Microsoft, who are just looking like they're on form at the moment. But Google, for me, where it was really impressive was the sort of advertising. And that sort of stuff as well. Like, that to me showed great recovery, and I was really encouraged by the sort of core business, shall we say, of Google rather than Google Cloud, which it does look, to be fair, it does look like it's losing out to AWS and other competitors basically, but AWS primarily, and then Microsoft to a lesser degree. But still, I'm very comfortable with Google. I did even consider sort of not too long ago wondering if I should sell down some Google and put it into sort of one of my tech ETFs, but decided not to. So outside of that, yeah, I'm so close to break even on Scott SMT. By the way, I've got like a buy price of like 6.94 now as an average, so I can't wait to that to turn green. That will feel like a really cool thing when it actually happens. I will happily be buying more mining, more real estate. Again, we are buying our small caps. What else we have here? Oh, banks. Yeah, so again, I remain very comfortable with this. I think I've got an average buy price of like 420 on this, but I'm negative on the FX as well. So I think we need like 430 odd to break even on this at the moment. So we'll see how that goes. And then my UK listed funds, so Frogmorton and Fidelity, they've been pretty beaten up. I kind of wish they were going to stay a bit redder for a bit longer, but they had a pretty good start to November, so they're looking a little bit healthier than they had been for sure. ASML, yeah, I think everything else has kind of already been covered here. So I'm going to leave it there, and then we're going to finish up with our non-financial performance over the last couple of weeks. So let's do that now. Alright, so in terms of contribution to wealth, because it has been a few weeks, there has been quite a significant change. Our overall target here is 70,000 for the year, so that is sort of, 5 and a bit thousand a month. So this is broadly as expected. But it was actually better than I was kind of expecting. Like, October was meant to be a more expensive month. But between my wife and I, basically the big difference here was a lot of poker wins. I had a couple of incredible sessions. I also had a really good blackjack session and a kind of mediumly good blackjack session. So, overall, I've just been able to add several thousand ahead of what I was expecting, kind of into premium bonds as well as my ISAs. So that's been really good. The only negative is that my DD for my junior ISA, so the ISA that we have with our daughter, didn't go through. I'm basically in the process of moving it from Nutmeg to Hargreaves, and it's just proving way more difficult for no obvious reason. Originally, it was like a letter was out on the account, and now it just seems to be taking a very long time. But it does mean that my DD hasn't gone through. So I will be doing a catch up on that just to make sure that on average, we give her £100 a month. But right now we're £100 behind where we should be. Outside of that I've just mentioned, a pretty good increase in our total wealth, basically, compared to the end of last month, which, believe it or not, this is actually the end of October, so it's amazing the 3 days that this basically covers is all the stock market performance. Again, a significant part of our wealth is tied to the stock market, either directly through the ISAs or through our pensions. So we are quite exposed to the vagaries of the stock market, and to a lesser degree the vagaries of the housing market. But there I don't get the regular reminder of how we're doing in quite the same way. So that's kind of interesting. There are 2 big adjustments that are still due, I would say. School fees haven't come out yet for my daughter's school, and my expenses from a business trip also haven't been paid to me yet. They should be paid in a couple of weeks or so. So that's like £1,000. And again, that's due. So that'll broadly cancel each other off, and we'll be just fine, basically. In terms of work, so outstanding at work here, this is like the highest grade that I can get. Previously, when I had my half-year review out of 4, I got 3.4. So I need to get like 3.6 in order for it to be classed as a win. But I'm pretty close, and honestly, it's quite difficult for me to get. I'm sort of fairly senior in my organisation, and my boss is quite expectant of me, which is not unreasonable. And but it's still a target. So I had a good catch up actually with him. He's been super busy with budgets for next year for the last month or so. But I was in the office on Thursday and got like an hour and a bit at the end of the day, so that felt good. Broadly speaking, good feedback. I've actually part of the reason why I was in the office was M&B kickoff. This is metering and billing. Without being too much of a nerd, basically, my employer is now at the size where we have to get a formal Ofcom regular audit in place for our total metering billing system. It is a 2-year kind of process, and we were kicking it off with one of the 3 approval bodies, and the one that we want to use because it's the most rigorous and the kind of biggest gold star that we can get. So that was good. I had a 3-hour session basically with the auditor. I think like me and 2 of my colleagues in my team have good experience with this, but it's a lot to do. And we will next steps basically will start from sort of Q1 next year, so that should be fun. I also had a bunch of supplier meetings basically as we start to sort of plan what our medium to long term payment and comms infrastructure will look like in our business. We do have sort of short to medium term plans already in place, but I sort of want to get it so that I can start talking to the CTO primarily about what we would like the sort of plan to be, and also to make sure that we're clear so that we're not tying ourselves into contracts and agreements longer than necessary. So I did get taken out a couple of times last week. It wasn't all bad, including a delicious steak lunch on Friday. So there are a few perks of the job, shall we say. And then lastly, actually, we've done our first migrations. So this is a big deal. We're going to be moving close to 200,000 connections from our legacy system to our new one, both in our billing and payment system. So 2 different migrations. So significant piece of work in my sphere. We've got a couple more trials, but this was the first one. And then we got 2 and 3. And that's a good start from my perspective and an important milestone. Revenue assurance targets. So actually there was a small further win, and by small I mean it's not that small, like it'll pay my wage for the year, so it's not insignificant. I'm also starting to scope B2B. A lot of our revenue assurance so far has been done on B2C. However, our B2B has been growing really well, and therefore sort of things that we might have overlooked or not deemed important enough to prioritize previously now makes sense for us to start looking at. So I've actually got a meeting on the 6th to kick that off with various people, so that should be exciting. Propensity to call reduction. So a couple of weeks ago I had a difficult session for various reasons, but we've now basically done all the actions and I feel refocused. I think honestly the whole work stream feels refocused because a lot of the reduction is based on the sort of new systems, etc., that are starting to come online. So that's sort of feeling good, and we're potentially very close to seeing some of the work pay off. In terms of team organisation, so I mentioned previously my personal budget's been accepted for my area for next year, so that feels good. I took the opportunity whilst I was on my business trip to share it with the third parties, so they're now clear on sort of how they can support us, etc. Pleasingly, the immediate win has been much higher quality and more accurate CVs, resumes if you're American, that we've been getting in terms of them. So much more sort of analytical reporting and data heavy people compared to sort of the credit control kind of experience we were getting before. Nothing wrong with that. I have credit controllers in my team. Just isn't really the right skill set for sort of billing analysts and payment analysts, different skill sets, etc. So that feels good already. I did very much enjoy my trip to Moldova, by the way. I really like Moldova. It's a bit of a strange one to have a third party in, Chisinau specifically, and I also toured a wine region, but specifically the largest storage of wine in the world, which was a surprise, honestly, but I was well looked after and, again, had a nice time out there, so that was good. And then the last one here, the end-to-end data reporting. So actually some modest changes. I've got some further calls next week, but specifically around debt in terms of how we're reporting, recognizing that, and sort of reclaims from the tax man, that sort of stuff as well. So that's been good. Next up, fitness and well-being. So again, another mixed picture. I'm only averaging sort of weekly at the moment, so that could definitely be better. However, like, despite my weight not moving anywhere, I have been told multiple times this week that I look thinner, I look healthier. So that's been nice to hear, honestly. I do feel like I've been eating a lot better, more regularly. My sleep has also been significantly better than it has been. I sort of mentioned that last time, but it continues to be strong. Actually, as well, like when my wife went away for 2 weeks over half term, I continued to sort of eat well, work out a couple of times again. It's averaging once a week, but actually I had a really good week where I did it like 3 times, and it hasn't been so good since. But yeah, that feels positive, honestly. Even things like drinking the right amounts, I haven't had like too many sort of drunken nights, etc. So that's like, I think the kind of general taking care is good, even if it hasn't yet translated into better weight and etc. Then relationships. So I've been super happy here. I was a bit nervous because every time my daughter goes away to visit her grandparents, like, she's a bit spoiled. She gets spoiled. I get it. Grandparents are grandparents. But this time she came back great. And honestly, the teacher gave us really lovely feedback as well. Or my wife specifically, really lovely feedback. That she was doing great now after sort of a difficult start to sort of proper school. So that was really nice to hear. I did have some time to myself, and I did expect all to do all kinds of things, ranging from sort of more fitness and or more time in the casino. But actually, I only went to the casino once during that period, and I instead used it as an opportunity to just get right on top of my work. So I had like an obscene amount of items outstanding, and managed to get my to-do list down to 9, which is honestly the lowest I've had it for over a year. So that felt great. But yeah, and likewise, looked after myself, did a lot of cooking. Even when I was in Moldova, like, I was eating well, I was sleeping well. So that felt good, honestly. And yeah, just some good quality time. I visited my brother-in-law's 40th party yesterday, actually, as part of the reason why this is late, as well as the fact that my charger stopped working, so I had to get a new one. But actually, somewhat surprisingly, I saw all of my family, which isn't exactly a big group. It's about 9 of them. But everyone was there, including sort of all my sisters, my aunties, etc. So that was nice. And my aunties are visiting London on Thursday next week. So I basically said, if you want, we can have lunch or go out for like afternoon tea or something. That's kind of something that they like doing. But one of my aunties is like massive Elvis fan. So, has like an entire room, and I'm genuinely not exaggerating, of Elvis memorabilia, big collector, etc. And there's an exhibition that they're going to next week, so that could be good if it aligns. If not, then that's okay. It was good to sort of catch up with everyone anyway. I did catch up with a friend over lunch as well, so that felt good, just whilst I was in the office and there was somebody nearby. Kind of the gap here between friend and connection, but I decided to put it in here rather than the professional, but I've done work with them in the past. But this was more of just a social catch-up, etc. I don't have anything professional planned outside of the sort of dinners that I'm sort of having whilst I'm doing sort of soft tendering. I wouldn't quite call it tendering. It's not quite that stage yet. But we are sort of talking to like 5 or 6 different companies in each sphere, and therefore occasionally have sort of professional meetings. In terms of development, obviously regular YouTube videos kind of sucks. I've just been prioritizing other things, frankly. I do apologize. I do sort of do this channel for two reasons. First of all, to keep myself honest, which is the most important, but also to kind of get better at public speaking, presenting, as well as sort of like making sure that you guys know what I'm doing, etc. So I do try and do better, but it is one of those things that I can sacrifice if needed, basically. And yeah, last weekend I like got back from Moldova like at 1 a.m, which was like 5 hours later than it was originally meant to, and I was just knackered the next day. And before that, again, it was like busy with work, so it was just not an opportunity to happen. So in terms of formal study of Polish, I have actually started. I put out a bunch of like feelers to teachers, basically, for want of a better word, but like natives who can help me learn. Started to get feedback from that. Also, there was a funny thing with my daughter where I was like putting her to bed one night, and I just said like dobranoc, which is good night in Polish. And for whatever reason, she had this realization that it was me speaking Polish, and it was just like her brain just exploded. Like, wow, like you can speak Polish. I was like, well, that's definitely pushing. Which was funny, because I regularly say things to her in Polish, but for whatever reason, she clicked. It wasn't English. That kind of made me laugh. So I also sort of had some videos on in the background when my wife and daughter are away, just sort of with like some vocab and stuff. So again, my vocab in Polish is probably my best thing. Like I have a good memory, I can remember lots of words. The difficulty is that the vocab changes depending on a bunch of scenarios that makes Polish an extremely challenging language to learn. But we are starting that back up. Also, as well, in terms of publishing a story, so this is taking longer than I've expected, but I am sort of in the process of sort of selecting and then agreeing terms with some illustrators, basically, to help kind of bring a couple of stories to life. Yeah, I didn't know anything about sort of some contractual expectations, shall we say, and how this market works. So that's been it's been taking a while, and some surprises and etc. So, but we are gradually making progress. I've kind of narrowed it down to like 3 people who I think I can work with. So hopefully we'll have an update in the next couple of weeks. And then regular reading, I did do some reading. I kind of really like reading in the bath, so if I can get like an hour or two to myself, which sort of happened when my family was away, then I can sort of get through a fair number of pages. It is a massive book, so reading 20% is like 70 pages. Massive. I guess there are bigger books, of course, but I've still got many hundreds of pages to go. But it's pretty cool. I'm learning kind of, I don't know a lot of the emperors that this period is covering, which is basically the 3rd century crisis. Which is a funny period, honestly, in Roman history. And it's kind of got that approach as well, where it's like basically like just crazy stories and lots of like funny anecdotes and things like that. So that's good fun. Very light reading, I would say, considering the size of the book. Anyway, that's everything I have now. It's very late this weekend, but again, we'll do this for now. I am hoping next week to have a cash flow forecast. I got good feedback from the original budget video I did about a month ago, so I'm going to sort of do a follow-up on that. And then we will try and do another video during the week, but again, we will see how we are for what's effectively my month end next week. So again, I expect to be busy at work, but we will try what we can try, and we can go from there. As ever, thank you very much for watching, especially if you made it all the way to the end. Any questions, etc., feel free. Otherwise, thank you very much, everyone. Bye for now.